Hey friends, good to see you again. Today we're going to talk about another topic that is under attack from the government, which is death taxes and gifting. And before we get too far into that, just recognize I've been an estate planning attorney full-time, about 20 years. Been practicing some form of estate planning for almost 25 years. And with some very, very minor short-term exceptions, do you realize the amount of money you can pass when you die has gotten bigger and bigger and bigger every year? In fact, when I started, you could only pass about $650,000, $675,000 at your death without owing potentially 40 to 55% in taxes to the government. So every dollar above that 650 would be taxed at 40, starting at 40 and getting as high as 55%. I mean, a really punitive tax. And slowly that number began to rise. In 2001, they passed a tax bill, and that started the rise. And it went from $1 million to $2 million to $3.5 million. In fact, we had a year in my career where there was an unlimited amount of money you could pass at your death without death tax. In fact, that was a famous year because George Steinbrenner, who owned the New York Yankees, passed away that year. And his family got to decide, do we want to pass it without estate tax, or do we want to pass it without recognizing a step up in cost basis, which I talked about in my last video. So when Trump got elected a couple years ago, they passed another tax bill, and now the amount of money you can die with and pass on to your family is $11.7 million. And that's each. So if you're married, you could pass $23.4 million if you do your planning properly. And so an incredible amount of money. In fact, so much money that almost no one is in that category. So the amount of people that actually pay estate tax is almost nothing. And the amount of money the government raises from estate tax is very minimal compared to the size of our budget. Now, let's make sure we understand estate tax. It's different than income tax. It's different than capital gains tax. It's different than really any other tax because it is a tax on assets when you die. Okay. Now, I don't want it to be confused with inheritance tax, which is a tax only in a few states, Nebraska being one of those, Iowa being another one of those, where they have a state inheritance tax. In Nebraska, we pay inheritance tax. Really, anyone pays it, including children, nieces, nephews, friends. Everybody pays it. There's some exemptions, but generally everybody pays it. Iowa, you only pay inheritance tax if you're not a direct descendant. So if you're a kid or a grandkid, you don't have inheritance tax. But if you're any other family member or friend, you're going to pay inheritance tax. So estate tax is taxed at your death, and it's only a federal tax. Again, with a few exceptions. I don't want to get too far in the weeds here, but Minnesota, where we practice as well, has a state estate tax. But for the most part, estate tax is federal. And it is taxed on, listen to this, everything you own and everything you control. So obviously everything you own is pretty easy, right? We own houses, we own retirement plans, we own personal property, we own cars, we own gold, whatever that looks like. If we own it, it's included in the calculation for estate tax. But it also includes things you might not think about. One of those being life insurance. Life insurance death benefit. So if I own a policy or my wife owns a policy on me, really if anyone, my wife or I own policies and that death benefit gets paid out because we pass, that counts when they calculate death tax. So that gets us at a higher number pretty fast. Now, it doesn't get us to 11.7 million, but it does get us pretty high. Now, here's why I make all those points in the beginning. When Biden ran for office last year, he wants to bring down the exemption amount to $3.5 million each. So take it from $23.4 million we can die with down to $3.5 each or $7 million as a couple. Now that still seems like a lot of money, no doubt. And for a lot of people, it is a lot of money. But for many of our clients, it really isn't that much money. When you think about owning real estate, rental properties, a business, farm ground, equipment, and even a pretty healthy retirement plan, you start to accumulate wealth to the point where maybe you start bumping up against that, or you're on your way to bumping up against that. Not to mention, if your life insurance counts and you're a couple that, still has kids at home, or you have debt on your property or something like that, that death benefit gets included inside of your estate as well. And the tax rates really matter, because the tax rates start at 40%, but the Biden administration and the Democrats in Congress want to raise that up again to 55%. So that's a frustrating thing to think about, because many people think the death tax is just frankly unfair, and it is. These are assets you've been taxed on your whole life for the most part. These are assets you've already paid income tax on, that you've already paid property tax on in certain cases. If it's a business, you've paid taxes on the profits. You've paid taxes to your employees. I mean, you've built these assets and you've paid taxes along the way. And then the government wants to tax it just because you die. And that is unfair. But that's what it's been. Now, historically, the estate tax has been around about 100 years. At some points, the tax rate's been as high as 77% under FDR. So we're not at historic highs, but we are at very high numbers. And with the economy doing what it's done, really for the last 10 years, 11 years, people's net worth is starting to get into that range. And if you don't do your planning properly, as a married couple or as a couple in general, $3.5 million might be your cap if you don't know how to plan, or you're not dealing with people that know how to plan. So I want you to understand that estate tax issue. Now, the second issue is gifting. And real quick, go back for a minute. Recognize that when the Senate does bring up a tax bill this year or early next year, the person that's going to write that bill, the chairman of the budget committee in the Senate, is Bernie Sanders, the socialist. And he has proposed $1 million exemption. And if there's $1 million exemption and life insurance counts, there is an enormous amount of people that will be subject to estate tax. And that's not meant to be a scare tactic. That's just the truth. That's what he's talked about. And so you've got the Congress and the presidency all controlled by one party. And as we saw with this stimulus bill that just passed, they can get things done without any Republicans on board. Okay, that's what they did with this COVID relief bill. Now, it was through a reconciliation process, which they can only do once a year, which eliminates the filibuster requirement in the Senate. But if they decide to bring up a tax bill early next year, then they'll be able to use that process again if they want to. And we have an election coming up, next year again. So they're going to try and get some things done before potentially the parties swap in the House or in the Senate. So we really need to be concerned about that. If you don't have a good attorney, that's what we are. We're attorneys, we're wealth planners, we're asset protection specialists, we're estate planners. And so our firm, Legacy Design, specializes in this work. And if you don't have a trusted relationship and you'd like to talk about this, we'd be happy to talk to you about these things and help you understand what possible scenarios and solutions you could use. And the last thing I would leave you with is that I hear all the time, these things will never happen. They'll never get these things passed. They'll never be able to accomplish this. And I just want you to tell you, we never thought that the Republicans would lose both the Senate races in Georgia. We never thought they could pass a $2 trillion spending bill without a single Republican vote. So every time you think something's not going to happen, we have two prime examples in the last really 5 months where it's happened. And so we ask you to be smart, be active. Do not be reactive. Do not wait for change to happen, because by the time the government actually passes a bill, they may make it effective immediately. They may make it effective retroactively, and then it will be too late. Have a great day. Thanks.